So there are a few things that we need to look for when we're trading a market to scalp. And in the next few videos, we're going to deep dive into each individual sector. So your FX, your commodities, your indices, and some of my recommendations, or some of the ones that I prefer to actually scalp. And then you can kind of use those and look at those and say yes or no. But as an overall thing for kind of going on further, regardless of what I'm recommending now, is choosing the market. So 6 things here that we definitely must have to trade. The first thing is got to be liquid. You've got to have liquidity in the market. It's super tempting, I know, to trade something that's swinging wildly, but it's not that liquid. There used to be a share, AVZ, and it was, you know, it was a good trading vehicle. Then it's kind of thinned out a little bit, and liquidity used to be a bit of an issue when you started trading size. Now it was a good, it was a great kind of trading share, but this was in the UK. But liquidity would be far less. So the spread would be wider, and yes, it would have great swings and there was great profit to be made. But if you can't get in or out, you get slippage, you get an awful spread. And if you're scalping, this is something that was suitable more for day trading, because you could kind of negate that a bit. If you were scalping it, unless you were taking that spread to your advantage, i.e. you were sitting on the bid, you were sitting on the offer directly on the exchange, you were going to get hammered with it because the liquidity would dry up. So it's tempting, guys, and there are kind of lots of US stocks out at the moment that are super tempting to want to scalp. But you're like, listen, if I don't get filled on the bid and I have to hit that offer, it's going to cost me. And if I start giving away money here and there all over the place, it's not going to be a long-term feasible strategy. So you want something that's got a nice kind of tight spread, and number 5 is what I mentioned, but really liquid, i.e. every single level there's a decent size volume that you can get in or get out of your position relative to what you're trading. The last thing you want, guys, I've been trapped in, I think I've told this story before. If you're a subscriber, you know, heads up to you, or shout out to you. If you're not, you probably haven't heard this story. I got caught out trading some bizarre like farm month on cotton. I was the biggest trader in it, and it wasn't even trading that much size. And I realized how important liquidity is. When you've not got it, it's like oxygen. If you haven't got liquidity, you're sitting there because you couldn't get out of a trade. There's not even enough liquidity to get out when I wanted. So used to be able to get in and out. I had to work the order, take awful thing just to get out, and it puts a bit of fear of panic into you, like I can't get out of this position. And so make sure you're trading a liquid vehicle. Number 2, volume. Different from liquidity, this is the amount of volume going through per minute, per hour, whatever it is. You want to see a good, solid flow, order flow. Nice high trade count, nice high volume, because that means there's always going to be liquidity for you to trade in and trade out. Now FX, no problem at all. FX, if you're trading the majors, forget about any of this, guys. The liquidity is more than adequate. The volume is more than adequate. If you go into some of the kind of minors or exotics, not necessarily the exotics, you still got to be a bit careful with the volume and liquidity. Definitely got to be careful of that when we're looking at equities, which we'll look at in a second. But you want good, solid volume, because that means there's money flowing in and out, means you can get in and out. And as a scalper, that's your lifeblood, that's your oxygen, that's your fuel, that's what you need. Number 3, volatile. So this is going to very much depend on the type of trader you are, right? Or the type of strategy you're employing as well. Generally speaking, though, as scalpers, we want volatile markets. We want a decent level of volatility. Not too much that we can't grab a handle on it at all, right? That's so crazy, but not so quiet that you can't get anything, because you kind of ticks up a bit, ticks down a bit. Almost impossible to drag anything out of the market. It's like getting blood out of a stone. If you've got a nice volatile market that's swinging good directions, all you got to do is take that chunk. It becomes easier to predict that little 10 tick move when it's swinging 50 ticks back, 50 ticks in a quick movement. It's easier to grab that 10, 12, 15 ticks, and gives you opportunity to be a little bit wrong and to extend your targets, and gives you loads more kind of things you can do when you've got a volatile instrument. When you haven't, and it's sitting there and it's stagnating, it's awful, because you're constantly trying to jump on things that you think's right. You're trying to fade things. There's not enough kind of pressure to stop it. It goes even further. It's very difficult to read, in my opinion. So you need some decent level of volatility. Number 4, cheap to trade. So this is kind of going to be 4 and 5, tight spread, cheap to trade. You don't want to be paying a big spread or expensive commissions, guys. You know, there's stuff out there like at the moment in time, Dow, for example, if you're trading a spread bet or a CFD, is super cheap to trade. The spread is so minimal, the price of it is quite high. So in proportion, the spread to kind of daily ATR is nothing. It's such a small amount. It's cheap to trade. Crude oil is cheap to trade when it's over $100, because if you're trading again CFD or spread bet, the spread may well be 3 ticks, say, and if it's trading 200 or 300 ticks movement per day, because percentage wise that's not so much for $100 a barrel plus as opposed to $20 a barrel, then it becomes cheaper to trade. So a tight spread, and again relative to the ATR you expect in the 15-minute or an hour, so the average true range you expect. So cheap to trade and tight spread, super important. I alluded to this earlier about costs and stuff, but spreads, it's so crucial, guys. You don't know it until you look at your spread and you go, hang on, I paid an absolute fortune in spread. If I just took 25% off that, I would be significantly better off. We don't want to be in that position. You want it to be a nice tight spread. Number 6 is some form of benchmark. So this really only applies to people who are trading via a CFD or a spread bet. So if you're trading on the exchange, obviously you're going to be trading a stock, you're going to be trading actual commodity future, or you're going to trade an index future. Or if you're trading forex, there's generally there's not central exchange as such. There's a kind of agreed price for it at that time. If you're trading something that's a little bit made up by the broker, this happens from time to time. They kind of make an index up and they say, oh yeah, it's the so and so broker index, and they include some things and then make it up. Or a little bit like that. We had a little bit like that with crypto, not so much with the bigger ones, but just being careful and cautious. If you're trading something like that that's got no form of benchmark, it means that they can make the price up that they want. They can have whatever price they want. Now, they can effectively with FTSE, DAX as well, but they've got to keep it reasonably in line, because if it goes out of line too much, then people are going to kind of trade that against maybe a basket of stocks. So you need some form of benchmark to trade against. This is an unusual one, I appreciate that, but there are times when there are new new sectors or new stuff, kind of hybrids put out there by brokers, specifically CFDs or spot firms or spread betting providers, and they say, hey, this is so-and-so index, we've made it up. And if you've got no form of benchmark, you've got no real reference point. Number one, you haven't got a chart apart from the one the broker gives you, and number two, they can clown around a bit because they haven't got to stamp it against the specific closing price. So anyway, guys, that's choosing your market, some things to definitely look out for.